everybody. Welcome to Friday, another Talk Money with Tom show today. This is actually going to be our last show this year. We're kind of excited, so we'll kind of highlight a few things that we saw happening during this year. But we do this show every Friday that we can when we're not on vacation or what have you, as really a free service to our clients and to the public, trying to help people, improve their retirement in the sense of finance, at least. So focus on retirement planning, asset management, tax planning, those types of things. Really, this is an area of education that is difficult to find, I think, and so we tried to create this channel to do that. So if you want to, continue to learn more, which we think is important, obviously you can subscribe to the channel itself, and you hit the subscribe button, the little bell, when you want to get notified for something new that comes on. And of course you can, meet with us if you'd like, and set the appointment button, which is at the top of our website. Looks just like that, and set up a time to meet with Ethan and I, 30 minutes. And so what we do here is kind of question and answer. So you can send in your questions, and anytime right now, send them in on the email. You can send them into the chat. And we'd like to answer those live. We have some other questions that came in. We answer questions that came up during our client strategy sessions also. So please send those in. Go ahead and go for it, and look forward to being able to try to answer those today. So anyway, I'm going to start as usual with a summary of kind of what I saw happening in the stock market this week. So we'll start with sharing kind of the chart that we look at. This is a chart. We started looking at this probably in the first quarter of 2022. We've been watching this thing develop and had this up for quite some time. And essentially it's turned into one big lumpy U at this point, because we're almost back. That point at the very beginning there was the all-time high, which was the closing high was on the 3rd of January of 2022. And so we're almost there again, finally. It's been quite the ride to get there. Let me back it up a little bit so we can see a little bit more time here. So this is back to 2018-ish time frame, and obviously we had the big pandemic that happened. We had a very strong run up coming up out of that. So it's the fastest 35% down in the history of stock market, but we had a very nearly vertical run after that.
Yeah, those 2 years were pretty amazing.
It really was, and pretty unprecedented in a lot of ways. Not completely unprecedented, but unusual at least. And it really had to do with how much money was being pushed out to try to save the economies of the world, really, from imploding during a pandemic when things were shut down and countries were shut down, airlines were shut down, etc. And we ended up, having a nice recovery out of that, at least for the stock market, but probably put out too much money in the end. Hard to tell.
Yeah, it's hard to tell when you're doing it,
Yeah.
but in hindsight, we may have put out a bit too much.
Yeah, because the top there, which was this January 3rd of last year, was all about inflation at that point in time, which was really starting to pick up. And the Federal Reserve is getting more and more aggressive about their conversations. And so, of course, then we end up with this downturn, because when you raise rates from basically 0 to about 5.5% in a fairly short period of time, you would normally have actually a much bigger downturn. I think one of the reasons that this market has come back and only fell 28% from high to low had a lot to do with just the fact that there is a pandemic here that makes it different.
Yeah.
And I've said this before, there's a couple things that make this different. The fact that there's a pandemic and this pent-up demand, money coming out. Secondly is 2008, we kind of discovered that we can do, stimulus programs and different
we can
types.
Keep the economy afloat.
Yeah, it'll be interesting to see if we can do that forever, because it takes a lot of dollars to do that. But that has helped even this year, as we're going to talk about this year. We had the Silicon Valley Bank, closure, First Republic, Signature Bank, et cetera. All these regional banks were really starting to struggle, and money came out of the government and kind of supported those banks and those programs in lots of different ways, but it worked, and we actually ended up with a nice upturn. So again, 2008, we didn't do that. We let Lehman Brothers fail. We had a 30% additional drop after that, down to a total of negative 57% from high to low. And so that's different. We're doing that now. So we have to factor that in as far as that goes. So now we get to kind of what's been happening more recently here. You can see this run up that's happened. It's unbelievable. And October 27th of this year was the low point here out of that downturn. That was a 10% downturn, right? And actually, I got a question this week from one of my clients. How did you know to stay in? Because it looked kind of bad, right? I mean,
Yeah.
all those highs are lower. It looks like the trend is changing. The last part of October there was really falling hard the last couple of weeks. And there's a couple things that are important to understand. There's a seasonality that happens. September and October are generally not the greatest months. The mutual funds that are out there have to capture their losses if they want to report them by the October 31st. So that's one of the things that goes on. These guys are selling those pieces. Oftentimes they're going to come back in and buy. And so, we did get a big jump right after that deadline. But one of the key things for us that's really important, and I think an educational point about investing, is you want to stay with the major trend until that trend has turned to the other direction.
Yeah, and there's going to be many 10% downturns and rebounds in your investing career. So, if you get out too soon, you miss out on a lot of the run.
Yeah, because the beginning of that run was monstrous. If you weren't already in the market on the 27th of October, even if it took you a couple of days to get back in, you probably missed out on 5%, run in that short period of time. And unfortunately, that's kind of how it works. And so primary direction, and everybody's got a different idea on how to do that. We look at more long-term things. My favorite area is really looking at kind of some pieces from Charles Dow, right? Charles Dow was the Dow Industrial Average was created by him. He was the journalist who started the Wall Street Journal. This is in the 1880s, and what have you. And he has some pieces that I think are really basic and I really like, and they still seem to work pretty well. So this is my piece,
Your version of it.
Yeah, and I add one piece from him and that I think is important. So the yellow line there is the 50-day moving average. So it's the average of the 50 previous days, each point on that. And then the blue line is the 200-day moving average. Mm-hmm. So for me, primary direction is upward when that yellow line is above the blue line, which happened back in February of this year, right? So that didn't stop. You can see it got closer by the end of October there when it was down, but it didn't cross, right? They called it a death cross for a reason. Didn't happen. You can see it's turned around. The other thing that kind of a secondary piece for me that's really important is the direction of the 200-day moving average. So when the 200-day moving average is up, which it never stopped being up in this particular last downturn, that's an important point for me. So those are two pieces. And then if you look at kind of part of what Dow talked about, he talked about a trend being, if you're looking at an uptrend, you're looking at the lows. Mm-hmm. If you're looking at a downtrend, you're looking at the highs. And so are the lows higher each time? And they were. And that was my main thing in that downturn in October. That low still had a long ways to go before it was going to get below the previous low, because there was a pretty big run up. And so sometimes when you get a really big run up, that was at least partly fueled by the AI frenzy that was happening, what have you. Sometimes when you get that big run up, you're going to get a bigger downturn. So if it's down 10%, but it was up that much before that. So I mean, one of the things, if you look at the Great Depression, is kind of interesting in terms of the stock market. It was down 87%, but if you look at that chart, it went straight up before that. So it was just kind of taking back at least a portion of that, was just that overabundance of run up,
the overvaluation of the stocks.
Yeah, and you can make that argument here about what happened during the pandemic. I think that's just too much run. It's very steep, and so again, unwinding some of that, and then we get back to somewhat normal. We're still unwinding the pandemic, I guess, is the main thing. So anyway, to answer that question, that's why we stayed in. It's why we used our rotational strategy, and why we've done very, very well in this upturn as far as that goes too. And one of the interesting things as a whole here is that the bond market is also participating here quite nicely.
It's been on a pretty major run lately.
It really has been. And so we have some slides coming up later in the show for a question that was answered. We'll talk about that too. But okay, so here's something from Bank of America's Global Research Department, and this is kind of interesting. And a lot of you probably don't know about this, but there's an organization called Investors Business Daily. They put out, used to be actually a paper way back when, and they have a thing called a cup and a handle. And I know that a lot of you might not have heard of this, but this is quite popular, and it has meaning because if a lot of people believe in it and it executes, and you get a buy signal, a whole bunch of people are going to be jumping in and kind of making a self-fulfilling scenario. So what they're showing here is that same chart I just basically showed, a little bit longer term, but the S&P 500, the big cup is the downturn, that happened 2008, hit that low 2022, hit that low of October. And then the handle was the downturn we just had, right? And so what they're saying here is if you break above the top of that handle, which was right around 4,600-ish, and we're at 4,700 now. Because this chart actually came out on Monday, and we're quite a bit above this as we speak. So we did it. We substantially broke out. And so their projection is on this type of move that we should, on a moderate basis, be in the 5,200 range, on a more aggressive basis, 5,600 range. And again, we're at around 4,700 right now. This is just the things that are out there. This is what's happening. We talked about the Zweig breadth thrust indicator that has 18 buy signals, all 100% accurate over a 12-month period, at least historically. Average rate of return is 23% in the next 12 months. You have a big month like November, you get that type of return. The average rate of return in the next 12 months is 14.9%. There's a lot of things because people are asking me what's going to happen in 2024. Well, if you look at kind of the averages for what happens when you stop raising rates, that's up, right, on average. When you have these big months, when you get this, breadth indicator that moves, cup and handle now is saying, hey, we're going to go to 52 to 5,600. These are things that are piling up on the positive side. Doesn't mean it's going to happen, but what it does mean is to be a good investor, you have to understand the positive and the negative. And that's the whole meaning of this show to a large degree, is that the negative is super easy to find. It's everywhere. It's lots of clicks, right? And gets people excited and gets them worried. And I get these emails from people, oh, this is going to happen, that's going to happen. What do you think of this? And they're not sending me this stuff. They're not sending me, so that's why we're doing this.
Yeah, and it's not going to be a perfectly smooth upper road. It'll be a little bit bumpy along the way, but the projection a long-term positive gain.
Yeah, it has been surprisingly smooth so far for this little run, which is I need to spend just a few seconds on that because it's a really big deal. I mean, this is something that doesn't happen very often where it kind of goes straight up. Going straight down like we saw in the pandemic, because fear is a very strong emotion.
It happens quite often.
Yeah, it's easy to do. Going straight up, much less frequent. It really is. It's kind of fun. Doesn't mean it'll hold, but it's still fun. I still think you got to have some fun when it's having a good time, and we should enjoy that. And so the Fed met this week, right? Came out on Wednesday. Chairman Powell did something I think quite surprising, and the market responded to it very positively. He kind of doubled down on the possibility of rate decreases next year.
Yep.
And it's caught people by surprise because even though they've had this dot plot out, we'll describe what this is in a minute. They put this out 4 times a year. That is showing that the average board governor thinks that rates are going to be lower next year. They really wouldn't acknowledge it. Higher for longer, higher for longer. And what they were trying to do is, talk the markets into doing some of the work for them. Have the bond market yields go up, which makes tighter money, right? Have the stock market come down, which makes people feel like they're poorer, and that creates tighter money. They've been working on that since November of 21, and all of a sudden they're looking at it the other way and starting to talk about rate decreases. So my own little pet theory, I mentioned this in the daily videos, but I'll talk about it here, is just that I think they're seeing enough softness in the economy upcoming that they feel that they want the market to do some of the work for them here by releasing some of the liquidity. So you start talking positively, bond yields dropped. I mean, the 10-year yield went below 4%. It was above 5.
Yeah, it was a quick drop too.
Yes, and so that makes monetary easing for the economy. The stock market obviously is up, 10, 11% from that low back in October. And again, that makes money flow too. So that's just my thought process, that they want to have the markets kind of pre-set this up so that they don't have to lower rates as quickly because things will be supported. Now, the problem, of course, is that there's a danger here because we're not truly out of this inflationary environment that we're in. The trend is the right direction, but that's my thought process. I don't disagree with what they're doing, because honestly, the one thing that's the biggest danger here is that the Federal Reserve does either raise rates too much or keep them up too long, and then something falls apart that doesn't get fixed and can't be fixed by government subsidies or what have you, and that's where you end up with that kind of hard landing. Okay, so this dot plot, the blue dots are from the September meeting. So again, this comes out every 4 times a year. The purple dots are from the meeting that just happened in December. So obviously in 2023, every single board governor had the same dot because this was the last meeting. They knew where it was going to be. They have a range, 5.25 to 5.5. You know, so
it's in that little in between.
Yep, that's exactly where that is. Now, if you look at 2024, you can see the purple and the blue are both lower than where we are now for the majority of the dots. There's a couple of dots in the blue there from September where they thought it would go higher, but they gave up and they all moved down. And so the average consensus, if you look at those dots, is a 3/4 point cut.
Yeah.
All right. Now, if you go to the CME Fed Market Watch tool, which is the gauge for futures market on where the Fed Reserve will be, they're expecting a rate cut in May and a total of 1.25 rate cuts, in for the year for 2024. So we'll see. Some differential there between what the market is expecting. The Fed seems to be saying, no, we won't be doing it that early and we won't be doing it that much. That's kind of where it's at. But they're not that far off. I don't think it's going to cause huge problems. If you follow that forward, they're thinking in 25 it'll be even lower. 26 it'll even be even lower, right? Does that long term it'll be even lower? Right around 2.5%. For the Fed funds rate, right?
Yeah, and there's also assumption that inflation will be similarly low too.
Yes.
So you don't need a high inflation.
Yeah,
rate.
And I'm sure the group that was in charge of the inflationary environment in the 70s thought the same thing because they had it under control. They started to lower rates, and then inflation got out of control. And so this is something that's going to be an impact on this particular regime because they know this and they've talked about it. Chairman Powell has brought this up. They're afraid of being that group that people look back at and say, well, you shouldn't have been lowering rates because things got out of control. This is not the 70s, so it is different. There are some supply constraints that are issues. There's too many open jobs versus people that are taking those jobs. There's some things that are different. And in the 70s, the big problem was oil. I mean, basically it went in a 7-year period from $4 to $40 a barrel, right? That's an incredible move. And right now we're at around $70-something a barrel. We're probably not going to go 10 times and go up to $700 a barrel. If we did, we would have similar inflation to what they had back then. So, but it's a different scenario for oil too, because the U.S. produces so much now.
Yeah.
We didn't used to. So this has some significance for the market because the market likes this if the rates are coming down, unless they're coming down because we're falling apart.
Yeah, if there's a recession, market does not like
That's
that.
right. So it kind of depends on the type of recession. I've seen some light recessions where, they declared a recession after it happened. You think, well, it didn't even know it, right? Mm-hmm. And those times, sometimes, they're lowering rates and the market's just moving along and doing okay. But obviously 2000, 2008, with those big, heavy recessions, you're going to get, some issues with that. So, anyway, this also has significance for those people that are doing CDs right now. We've got a lot of people doing CDs. And so maybe a little bit longer term CDs or longer term treasury bonds. If rates are going to come down, you might want to lock in some of these rates, on a ladder or what have you. So I think that's important to understand. Okay, so last piece here. This is just kind of fascinating. Again, this comes from Bloomberg. It is basically a combination of what is expected coming out of the Federal Open Market Committee, the Fed. So the black lines in here.
Actually, this is just an economist.
Right. Yeah.
Their project.
Got it. And the black is this year, 2023. So if we just kind of go down, the Fed funds rate, the GDP growth, so that's how much the economy is growing, right? Unemployment, PCE. This, again, they're not using CPI. Finally, the press is catching on that PCE is the measure of inflation that the Fed is really looking at the most. And then core PCE is the piece that they're looking at even more than just overall PCE, which is where they take out food and energy. So if we look at that, if we look at the Fed funds rate, the pink-ish is next year, blue is 2025, green, yellow is longer term, and then long run, longer than that. So you can see they're expecting the Fed funds rate here all across to come down, right? Next year, the year after, long term and long run, all coming down, right? So that means rates coming down fits in with that dot plot. Yeah. GDP growth better this year than they're expecting and on these other years. Next year, that should get soft.
Yeah, there's slowing of the economy.
Right. Now, technically, a recession is 2 quarters of negative GDP. This is still showing a 1-year positive. So you can still get 2 quarters to squeeze in there at a 4, but not expecting probably, in my opinion, on this chart, a recession next year. But we'll see how that works out. And then things kind of picking up to more of a norm in 25 and beyond. Unemployment rate goes up some, right? Next year, the year after. That's not going to be a surprise at all with the amount of rate increases that they've done. The Fed has projected that we would move to 4.1% quite some time ago. We got up to 3.9 and then dropped back down to 3.7. So still very good market. Still full employment is considered 4%. So, and then inflation, PCE, and core both falling, right? That's the projection. So all of those things are really good for the stock market, assuming that whatever slowdown we have is more of the soft landing or not such a hard landing. And so that's going to be. I've been saying this all the last couple of weeks here. I think we're shifting the conversation from inflation to recession, and that's going to be what we're hearing about, because you can see the data comes out. And you can look at it either way. So we get lots of jobs. Oh, the market drops, because that's an inflationary look. And when you're thinking about recession, lots of jobs, market will go up, because that's going to help us to get out of recession. And jobs aren't a great example because it's a lagging indicator, but nonetheless, that's what we're looking at. So altogether, really good, time frame. To be in the market. The year turned out to be fantastic. Still, making back what we lost, unfortunately. Even this run up we just had, we're still, just barely getting above where we were back in July. However, that's what you want. You want, some direction. And the market is, roughly where it was almost 2 years ago. Companies are making more money, right? The growth rate slowed down some, but it's still positive. And so if you look at the S&P 500, so they've made more money. The earnings are higher, even though the price hasn't moved in 2 years.
Yeah, so it's kind of like the thought that it was overpriced in 2022. Yes. Now it's kind of the earnings have caught up, and now the price is kind of according.
Yeah, it's still overpriced on a very historical basis, no doubt, but not nearly where it was, before this started, right? So what happens is that this is the way the market kind of lets off that steam and lets things get back to, some reasonable level. And the market is a representation of human emotion. So we almost never at a reasonable level. We're either, a mania on one side or, total, panic on the other is kind of not unusual. And so you just have to kind of understand that and be able to ride through some of those things. And, when things are really flying, have a more moderate outlook on that, and when things are really falling apart, have a more moderate outlook on that also. There are certain places where you got to be careful. We don't want to ride through the next Great Depression, but generally speaking, this year, none of that was happening. We had a 10% downturn, as you mentioned. That's not that uncommon. So that's what we've had for this week. Really enjoy everybody watching these summaries. And again, we'll be doing this again at the beginning of the year, January 5th or 6th or whatever the next Friday is after the New Year's, and we'll talk about that then. So thank you for watching all of these. All right, so let's talk about our questions.
So, with the expectation of the Fed holding interest rates or decreasing them, where does the market go from there?
Okay, so it's a good question, right? We just talked about all these scenarios where it looks like the Fed will be lowering rates next year. And so how does that impact things? So we have a nice chart for this. It's really interesting. A little bit confusing, so let me try to describe this. But the average rate of return, okay, after a 3-year, right, average rate of return, after a rate stops moving and starts to move down, yes, which is kind of where we're heading supposedly for next year. You can see this particular chart, we have stocks and bonds, and across the bottom we have kind of standard deviation, so how much risk and volatility is happening. And then across the vertical axis is return. And so first of all, if we look at bonds, I think this is a really interesting chart if you dig into it. Number one, they're quite clustered together. In all of these scenarios in the past when rates have come down, bonds, first of all, they've all been positive, right? And they're not very far away from each other. There's two reasons for this. Number one, bonds have less standard deviation. You can see that. They're down in that 5% range or below. And so they don't tend to disperse as much. That's kind of the definition of standard deviation in a sense. And stocks have more dispersion, but and you made this point. So tell them about why those stock ones are down. I think it's really interesting.
Yeah, because stock is more the economy. What is the economy doing? Are we in a recession? Are we in a growth phase? You can have interest peak out and still be in a growth phase, but if your interest rates are going down because of a recession, you're going to have stocks go down, and that's why you can see that that massive standard deviation.
Yeah, so if we take 2000 and 2008, they were lowering interest rates to try to keep the economy going, but the stock market was still coming down too, because those were pretty hard recessions and big adjustments to the economy. Whereas the bond market, there's a lot of little pieces that drive the bond market, but boy, you got to put right near the top interest rates. They basically go the other way. So when rates are coming down, they go up. And so even during a recession, they're lowering rates to try to stimulate the economy. Bonds go up. We saw bonds go up pretty substantially in the pandemic downturn because again they lowered rates down to zero and they went up, and so it was actually a play that we did that worked out quite well. Now this other chart here with the two bars is called the Sharpe ratio, and this is basically just the overabundance of return versus the standard deviation. As a very simple definition, it was Dr. Sharpe created this, and so the higher the number, the better. And you can see for every unit of risk, you're making more money in bonds in this particular environment than you are in stocks. We started talking about in the middle of this year about there's going to be opportunity in bonds at some point in time, because they're a fairly simple play compared to stocks. And if you go out far enough on the spectrum of term, you can actually get stock market returns in that area. Now, you're taking stock market risk. But that's where we're seeing a lot of the big hedge funds are playing in that long-term bond arena, right?
Yeah, and they probably made sizable returns in the last couple of months.
Yes, very much so. Because you can have a 10, 20%, 30% rate of return on a very long-term treasury. And so there's a couple of ETFs. One is iShares 20-plus year treasury. That's ticker symbol's TLT.
Yeah,
right?
I think some of our clients there's some of the people are up 20% on that.
Wow. Yeah, and then EDV, which is even more aggressive, which is the Vanguard extended duration. It's actually a zero coupon thing, so it's really meant to just play the run, is another one where we're seeing some action. So bonds are worth looking at here as part of this scenario, because historically they've had, again, a higher rate of return per unit of risk taken, as noted by that 1.17 on that Sharpe ratio. So I think this is a very fascinating chart. I wouldn't be surprised to see in our particular scenario the market being up over a 3-year annualized basis instead of those two down ones, just because this isn't a massive economic breakdown. That could happen. Honestly, I still feel like if they let Silicon Valley Bank go and just let the regional banks go and didn't do anything to step in, I think we're looking at a 2008 type downturn personally. But because we're still in that stimulus, bail things out mode, I think that supports that market, keeps those things from breaking. And then also, really, a piece of this inflationary environment was just we didn't have the right supply. First, we didn't have the right goods. We couldn't get them here.
Yeah.
They're out in the port in LA or whatever. And then we shifted all our money spending over to services, and we couldn't get enough people to come back to work right away. The people had shifted their roles, and where there used to be 2 people working, now there was 1. They moved to a cheaper area. There was, a lot of things happened in the pandemic, and we have had a lot of job growth, but we still have 8.7, 8.4, can't remember, million open jobs, which is still a huge number. So, anyway, that scenario is still working its way out and could keep us from having a really hard recession or something breaking. So I wouldn't be surprised to see stocks being in that upper range above 0, but the bonds are definitely something to pay attention to. And we've been really enjoying the run that we've had in our portfolio in the bond pieces. Really good.
It's been a while since we've
Yes.
seen, thinking about bonds as a part to actually augment your returns.
Yes, exactly right. I mean, unfortunately, we're still just making up for losses in a way too, because the bond market had such a horrendous 2022 and really most of this year too, up until recently. So, but we're getting some of that back pretty quickly. It's kind of exciting to watch. So, great question.
So this question came in chat. Is Martin Zweig's theory still working? Let's see. Here's a quote about Martin Zweig.
Yeah.
In the stock market, as with horse racing, money makes the mare go. Monetary conditions exert an enormous influence on stock prices. Indeed, the monetary climate, primarily the trends in interest rates and the Federal Reserve policy, is the dominant factor in determining the stock's major direction.
Yeah. Well, I also think that they're talking about this breadth thrust indicator that Zweig created. He is very famous for don't fight the Fed. And matter of fact, he had a piece in his book called 3 Steps in a Stumble. So when the Fed raises rates 3 times, the market stumbles. The breadth thrust indicator, which signaled really at the very beginning of November, is a 10-day look back period. And it's a bit complicated on how they did it, but in essence, what they're looking at is when you have a massive move and it is highly participatory. There was lots of different stocks participating, and you get through a certain level, it triggers a buy. And since 1945, there's been 18 of those, right? And so here we go. We've got another one. The last 18, every single time the market was higher in 12 months, and the average rate of return was a little over 23%. I think it's 23.4% to be honest. But so is it still valid? Yeah, I think so, because what happens is I'm a huge believer in momentum, right? And so what he's looking at there is a massive motion and momentum with a bunch of money coming back in. And that creates a scenario where all of a sudden, okay, we got more short covering, which brings in more money. And then we get the fear of missing out, right, which brings in more money. And every little dip we've had here, what was it, last week we had 3 down days, Monday, Tuesday, Wednesday, thinking, okay, maybe this is it. And then boom, it comes back up again. I am looking for some softness here at the end of the year, and maybe looking at that as actually a buy point coming up too. But, it's happening. They're actually moving in that direction. And you combine that with a great November as a whole. It wasn't just that 10-day period. So yeah, I think that still has some validity to me. And, anything can happen. And that's the thing, because there are all kinds of things that are just uncontrollable. I always said that there's always like this, I call it the outside influence, some type of, major war that was actually affected the economy. To me, a nuclear scenario would definitely be in that situation. The market, you could throw a lot of things out the window. So that's always there. That's always going to hiccup any plan that anybody has, is this kind of wild outside scenario that happens that nobody's expecting, right? And so, but take those off the table. Shouldn't, but you could. Yeah, I think it works. I think the power that we're seeing here There's a reason too. It's not just, oh, this just happened. Well, the Fed stopped raising rates and
Yeah.
talks about stop raising rates. We're seeing inflation continue to fall. We're seeing supply side getting better on services and what have you. We're seeing inflation, on a PCE core level continuing to come down slower than we'd like, but still coming down. There's some reasons that this is happening, and you combine that because on that show when we talked about that was October 27th. Sorry, we talked about after that, but October 27th was when the Bank of America survey came out that said that the major money players, the pensions, mutual funds, hedge funds, based on that survey, were at the lowest exposure to stock market,
Yeah.
right at the bottom of that downturn, which also means that there's a whole bunch of money that can come back. Yeah, and it has been coming back and coming back. And we're seeing some really interesting things run. We're seeing high dividend paying stocks making a big run. That is something that the major players, especially the pensions and those types of things, they love that area. So I think people are starting to feel more comfortable with what's happening here and starting to come back into play.
What percentage of do you think the money is still on the sidelines? Because I know a lot of people have started to park, or because just your bank rates are so much nicer now, have
Yeah.
started parked money in cash.
Oh, yeah. Well, that's the individual side. There's the individual and then there's the institutional side, right? And the individual has a lot more power than they used to, at least the 2020 group. I call them 2020 group because they started using these options, call options, to basically make a bigger impact on the market than they would. The institutions, though, I remember just a few weeks back we had that one chart that showed stock market exposure. Remember, it was like a histogram,
Yeah.
and it had come way down, and it was just back to like average.
Yeah.
Right. But when we looked at that chart, when it went negative and it came back to average, it also went quite a bit above average.
Yeah.
And so I think that trend, so we're still probably around average exposure where we were under before. And they're the main movers. They're going to move it. And what will happen then, they get in there. These are professionals. The other thing you have to understand about professionals is they're all competing for their job and to keep that money against some index or blend of indexes, just like we are.
Yep.
I sit down with clients, I say, here's how we did versus if you would have had the money at Vanguard in that same percentage, here's what you would have done. You wouldn't have had a fee. Here's what we have after the fee. I mean, this is how we discuss this. And so we think about that all the time. So you can't, when the market goes up 11%, you can't sit out.
Yeah.
You can't keep it in cash because you're probably competing against some index that's going to include some motion that was been very, very up. So this kind of drives that money in. And I think the secondary thing will be what you're talking about, which is that, hey, I'm getting 5% on a CD. That sounds great, 5% on a CD. And all of a sudden, wow, I just made 12% on my stock market account, and if that keeps going, I'm going to move some of that CD money over because, so it's all relative. When we were losing money, 5 or making small amounts, 5 sounded great, right? So, yeah, it works out in the end. I mean, look, you've got CDs, bonds, stocks. I mean, in terms of long-term returns, you can go look at that. Things work out in the end. Those averages tend to be, what plays out. Not that you shouldn't have CDs. I love them. You should have a nice ladder of CDs. That's perfect. You should have your emergency money, but you're not going to outperform the stock market over the longer term with CDs.
Yeah.
Right? I mean, it's happened. We had a 10-year period that ended in 2009 that was negative. So you would have won for 10 years with CDs. So it's possible. But we're not really looking at that at this point in time, potentially. If we were, that'd be a different conversation. But, over the long term, the stock market outperforms CDs. So that's going to be the driver that brings back some of that other money that's sitting in money markets. We've had conversations with some more conservative clients even this week that they were talking about, well, we got all this extra cash now, we should be investing it, and it's like, okay, whereas that wasn't a conversation we were having before, whether that's a good idea or not, we'll see how that plays out, but that's what's happening. That's the reality. So I do think we'll see some individual money coming in, but the pensions and the big guys will probably be driving this first. And I think they are driving it now.
So do you see any industries or sectors that would overperform with a stable or declining interest rate?
Okay, so what does well when interest rates go down? Yeah. we discussed in the earlier question about bonds.
Yeah, long-term bonds really perform well.
Yeah, and so bonds move, right, to adjust for the market. And the reason is because a new bond comes out at a higher interest rate, then you've got to lower the value of an older bond to get it to that higher interest rate, if that makes sense.
Yeah, so you want the yields to be the same.
Yeah, they always work that way. The opposite happens when yields come down and new bonds are coming out that are lower than these older ones, then the value goes up to lower the yield back down. Okay, so if rates come down, right, which is the projection at the moment, then bonds will go up. And treasuries are pretty clean because they don't, it's the U.S. government. You start getting into corporate bonds and agency bond, you get into all kinds of different, but in general, interest rates are a massive driver. And so what you want to do then is you want to look longer term. So you won't see hardly any motion whatsoever in a T-bill because it only comes due in 90 days. It's going to come due and give you back the same amount of money. It's not going to gain that much in that 90-day period before it comes back to where it was. You go out to 20 years, whoa. Yeah. I mean, so we've seen some 20, 30% gains just in the last, 6 weeks?
Yeah.
And some of those really long pieces.
It's crazy because you're starting to, when you say that returns, you're thinking stock market returns from a bond.
That's right. And unfortunately, you have to be careful here because that long-term treasury is as volatile as the stock market, as the S&P 500. So you want to keep that to a small degree or even replace some of your stock market components with bond piece like that and pretend like it's a stock because it moves like a stock. But there's a play there that is, we just looked at that chart and shows, let's look at it again because it's pretty interesting. This chart shows there's 3-year returns, adjusted risk returns after the last Fed rate hike, right? Look at bonds, fairly decent returns. Looks like probably an average of 10% per year, average rate of return in the middle there, give or take, and a very tight cluster with very low standard deviation and a Sharpe ratio, which is excellent at 1.17, right? That's a play. There's nothing wrong with that whatsoever. And we're certainly playing that and plan on continuing to play that as long as the rate decrease scenario continues. So other areas, right?
So any kind of industry that's going to have any kind of, large capital requirements. So one example would be green energy. A lot of green energy projects take a lot of debt on, and so lowering interest rates makes it cheaper for them to actually finance their growth. Yeah,
we are seeing some big runs. There's iShares Clean Energy ETF, ICLN, iClean, that's been having a horrible time for quite a while, but just recently really, really going as the Fed, has basically said that this might be their last rate increase. And so that's because there's high leverage in that arena. It's a very capital intensive concept.
Yeah, and you can see some analysts have started to upgrade a lot of the solar companies too. So you're starting to see a trend where anything projects that need money, they're getting bumped up now.
Yeah, because they can get it for cheaper. I mean, it was free before, and clean energy was doing pretty well. When rates were that low, and then when the rates come up, so it's a more sensitive to interest rate environment. The other thing that has been running really well, especially this week, has been higher dividend paying stocks. SPY is an S&P 500 fund that's put out by State Street. They have one called SPYD, which is basically the higher dividend paying components of the S&P 500. These are both ETFs through State Street, and that's had a big run, especially since Wednesday. And the reason is because, again, SPYD was paying around 4.5% dividend, right? It's just like a bond. And so anything that has a higher interest rate is going to basically have an appreciation of price when that dividend starts to come back down because the price comes up. It has a relationship to what's happening in the bond market.
Yeah, they try and equalize that yield. There's kind of like an arbitrage situation.
There is, so that's another area that I think is really interesting to look at, just in terms of an interest rate environment like this. However, I think you just want to be in, for one thing. Wait and see what happens if we have a hard landing or not, and kind of react to that. Use the things I've been talking about with primary trend. Stay with it if its primary trend is still up, and make your adjustments when it's not. You have to have some patience there and some courage to hang in there when things do go south. But I think that those are some pretty good areas.
Yeah, when you're kind of doing these little targets, you always want to keep them small because you don't want to put all your eggs in one like kind of scenario.
Yeah, we work on a core target basis with our portfolios. So majority of our assets are in core holdings that are very well diversified, S&P 500 or the Vanguard Total Stock Market Index type holdings. And then we have these targets where we try to find some pieces that are moving. And so I don't need to know the theme. So what we just talked about was what I call a theme, where you have, okay, the market is going to go in this direction and these are going to do well because this is happening, right? Mm-hmm. So rates are coming down, clean energy, high dividend paying stocks, bonds are going to do well. What we have is this competition, say 130 ETFs on a list, and we're looking for the ones that are moving up towards the top, and we're going to hold on to those until they get past some cut line. Mm-hmm. So what we're doing is we're constantly optimizing out of that 130. What's the cut line? So for example, right now on one of our, we have 16 pools of holdings. And one of our pools, our main target pool, 130 holdings, got to be in the top 55 of the last 70 days, right? Now that's going to change maybe next week as we re-optimize these. And so what's happening is you'll see high dividend come up if it stays and is sustainable to a point where we feel like it's going to move, because in our back testing we can see, hey, that's the optimal time to buy that and capture that run, and then when it fades off we move into that next wave. Mm-hmm. And so that is kind of the way we do it. And because the themes sometimes can break down, so I'm much more interested in kind of the competition. I played soccer, and so to me it's like you've got this big bench, 130 players on the bench, and 11 can get on the field, and they're all competing for that. And as long as they're producing, I'm keeping them on the field. And when they start to slow down or tire, what have you, I'm substituting somebody else.
It's kind of like what the Warriors did, with Wiggins. He was underperforming, so they put him on the bench and they brought in one of their bench players.
Yeah, because the bench players are playing better. That might change and Wiggins come back or what have you, right? But yeah, it's a good point, and that's kind of how I look at it. Is just sort of this competition. So. All right, we are done for the year. Really enjoy everybody joining us here for the show. It's been a great year altogether, really fun for us here. We love doing these shows. So please, you can send in your questions even here at the end of the year. We've got a few weeks before we get back together. It's great if you send them in early. We can do a little bit of work and pull up some visuals and such too. So look forward very much to being able to see everybody kind of that first Friday in January. Again, you send in the questions, and then you can also subscribe to the channel. It helps us, actually, if you subscribe. If you want to do that, that'd be awesome. But also, I think it helps you, especially if you hit the notification button, new things coming in. And we'll be able to, continuously update you on what's happening with the market and what's happening, in the financial planning arena and what have you too. So, and then of course, last thing is you can just set up a time with us if you want to meet with us and chat about something, that's personal to you. Then please do that. You go to our website. There's a link here, book appointment button up in the corner, and our times are available. You find a time to meet with Ethan and I for 30 minutes, phone, video, face-to-face, whatever works for you. So thank you everybody very much for coming. I look forward to seeing you again next year.